Welcome back to the channel that simplifies the stock market. Now, in this video, we're going to be completing our analysis of Synchrony Financial. We'll look at the company's cash flow statement and balance sheet, and then we'll look at things of value within the company that could potentially lead to future growth, which will be a good thing. And then to end it off, we'll explore whether Synchrony Financial will make a sound investment decision for you and whether you might want to add the company to your portfolio. Now, where do we leave off? Cash flow statement. But wait. Okay. Now, this is how you navigate to the cash flow statement on Yahoo Finance. You click Financials, then you just click Cash Flow. I always look at each of these statements within the company's actual 10K and 10Q report before I actually buy. But Yahoo Finance gives this interactive layout, which is good for my quick scan. So, the cash flow statement. Now, while the income statement is helpful in showing us the company's revenue, expenses, and net income, it includes non-cash items, or IOUs, on behalf of both the company and the company's customers that haven't been converted into cash or paid out in cash just yet. But see, here's the thing. I, being an investor, don't get paid in IOUs. Neither do the employees of the company. And every company will eventually have to pay cash in order to cover its expenses. Everything ultimately gets paid in cash. So if the company wants to be around for a long time and be successful, then it needs to generate some cash and convert its IOUs into cash. And this is where the cash flow statement comes in and why it's so important. It shows you the flow of cold, hard cash within the business. Here you can see the cash that Synchrony Financial generates from its day-to-day operations. And this is good because it's positive, although you see a dip from 2019 to the trailing 12. Now, if these numbers were negative, this wouldn't be good because this would mean that the company is losing cash from its day-to-day operations. And remember, a company needs cash if it wants to be successful in the long run. A company that doesn't have the cash to meet its obligations is at risk of being insolvent and having to shut down. And if you're part owner of that company, then you'll lose your money because no one will buy shares of a company that's shut down. It doesn't exist anymore. Now, for the investing cash flow, you generally want to see a negative number. This means that the company is spending cash in order to invest in its growth. It takes money to make money. So I want to investigate why in the trailing 12 months, this number was positive. This positive number means that they sold things that could lead to great growth rather than spending cash in order to invest in growth. And I see that net proceeds payments for a loan is positive 7.6 billion. And this means that the company sold off a lot of its loans and took that cash back. Now remember, this company earns its revenue by collecting interest on loans. So right now it's missing out on the interest that it could receive on this 7.6 billion, which now explains why revenue has dropped off a bit in the trailing 12 and why operating cash flows are lower as well. But it makes sense why a company would do this. With the shutdown of the economy due to COVID and unemployment rising, the company was likely anticipating that people would struggle to pay interest on the loans and pay the loans back. So to reduce their risk, they likely just said, hey, we're just going to pull this 7.6 billion back and forego the interest that we could be receiving on it because people might not be able to pay the loans back in the first place. And, we risk losing a large chunk of this 7.6 billion. So it's just something to keep an eye on. We do want to start loaning this cash out as soon as possible, but only when it makes sense to do so. We definitely don't want to rush it. Now, for the financing cash flow, we see that the company paid off debt of 4.6 billion and repurchased their own outstanding shares amounting to 2.3 billion. And both of these are good things. They add value to shareholders. And finally, for the financing cash flow, we see the cash dividends paid. And this is good because this means that the company has consistently paid cash dividends for the last 4 years. That's how you get this figure here. And to wrap up the cash flow statement, we'll look at some very important figures, which are these right here, the free cash flows. Now, a company's free cash flow is a source of cash that it uses to pay its owners a dividend and then pay any interest on any debts that it might owe. Now, this is the equation for free cash flow. Operating cash flows minus capital expenditures gives you your free cash flow. But of course, I'll explain it so that you understand it and it's not just a formula on the board. Now, operating cash flow is a cash that a business generates from its day-to-day operations. And generally, positive is good, negative, not so much. Capital expenditures, or CapEx, is a cash that a company spends in order to buy and maintain its capital assets. Now, capital assets are the equipment that the company uses in order to generate cash, the property that the company conducts its business within. And if it's a company that manufactures things, then the manufacturing plant. So basically, these capital assets are what the company owns and uses in order to generate its cash flow. They don't plan on selling them anytime soon, and they must maintain them if they wear out or break down, because without the capital assets, the company won't be able to generate its operating cash flow. So when you pile up all the cash that a company has generated from its day-to-day operations, and you take a portion of that cash and you spend it on the plant, the property, the equipment that a company needs in order to continue to generate cash, then ideally you want to be left over with some cash from this pile that you took from. And that leftover pile of cash is your free cash flow. Now, if a company spends $1 here to make $10 here, then that's great. Phenomenal. It gives free cash flow of $9. On the flip side, if a company spends $9 here to make $10 here, then that's not so great. I can make a video later explaining this concept further with an example, and in fact I probably will, but for now let's get back to Synchrony Financial's cash flow statement. So right here we can see that Synchrony Financial's free cash flow is the same as its operating cash flow, which tells us that the company doesn't have to spend cash on plant, property, or equipment because it doesn't have any. But we can confirm this later on the balance sheet. But this is actually a great thing. We can see that here in this sentence, through our partners over 410,000 locations across the United States and Canada, and their websites and mobile applications, we offer their customers a variety of credit products to finance the purchase of goods and services, which means that Synchrony Financial leverages its partners' property, infrastructure, and equipment to produce its cash and doesn't actually have to pay or spend its own cash on these things. And that's beautiful. Like, that's beautiful. So far, things are looking pretty good. Not perfect, but pretty good. But let's go over to the company's balance sheet to make sure it's solvent. Now, with the 10Q, every 3 months, public companies send out their financials to the public so they can show how they performed in the last quarter. And this is the information that you'll find in the 10Q report. As for the balance sheet, unlike the income statement and the cash flow statement that shows the company's financial performance over a time period, the balance sheet shows a snapshot of the company's assets, liabilities, and equity on a given day, which is why I choose the company's latest 10Q so I can get the company's latest balance sheet snapshot. Now, because Synchrony Financial is a company that primarily deals with debt, there are two numbers that I'm primarily focused on. This figure here, loan receivables net, and this figure here, total deposits. This loan receivable amount right here of $68.3 billion is the money that they've lent out and are receiving interest on. And really it was $78.5 billion, but they said, hey, we're probably going to lose $10 billion allowance for credit losses of this because some people borrowed from us, but they likely won't be able to pay us back. And the total deposits amount of $63.4 billion is the cash that people have deposited with Synchrony Financial, and Synchrony Financial has to pay them interest on this amount. Now, the company will charge a higher interest rate on this, so what they lend out than what they'll pay right here, and that's just business, but it's good to see that this balance right here is higher than this one. But on any balance sheet, these are the company's resources, so the assets, and these are how they fund those resources, so the liabilities and equity. So right here we can see that Synchrony Financial's free cash flow is the same as its operating cash flow, which tells us that the company doesn't have to spend cash on plant, property, or equipment because it doesn't have any. But we can confirm this later on the balance sheet. And now we've seen the three financial statements of Synchrony Financial, and they look solid. The company is profitable, they're solvent, and they have good cash flow. We saw their revenue and earning trends in part one, and we saw they were uptrending up until last year, the COVID year. We saw that the reason for this was because the company sold a lot of its loans in order to protect its cash. But at the same time, they lost out on that interest income that they could have been receiving that whole time. And now we're done with the numbers, so we'll set those aside and focus in on the more exciting part of the analysis, which is looking at the prospects for the future. What value is within the company that's going to likely cause it to grow in the future and put more cash in our pockets if we own it. And for that, we'll look at some recent news and reports. And in this video snip, I'm just going to look at some latest news reports and some things from their website, but I also encourage you to go to their annual report and actually read the first few pages before the 10K actually starts. It'll give you some useful information as well. Now, this first one is just talking about how Walgreens will launch new credit cards issued by Synchrony Financial. Cool. This article speaks about them a good bit, but I just want to point out again some of their partnerships. So Venmo, Lowe's, Gap, Dick's Sporting Goods, JCPenney, and Amazon. And this article is just talking about Margaret Keane, who's the now former CEO of Synchrony Financial, and she's stepping down, but she'll still remain with the company as executive chair of the board. So we're just going through a transition period as far as with the former president, Brian Doubles, taking over as CEO. So just hoping that it's a smooth transition and he's able to do just as good of a job as she has done, or even better, but we definitely don't want worse because she's done a pretty great job. And this is just the company's website news article that they released themselves talking about the introduction of the Venmo credit card. Again, from the company's website, a news article talking about the Verizon Wireless Visa card. And this is PayPal's actual website, and I just wanted to highlight this sentence right here. PayPal credit is subject to credit approval and is offered by Synchrony Bank. So again, this is just to highlight that they have dealings with a lot of great companies. And now we're at the point where you're probably itching to know, should you buy it? And just as a reminder, this is what it looks like today if you chose to buy it. So in the last 12 months, it earned $2.23. Of that $2.23, you got to pocket 88 cents to spend it how you please. And the price tag to get these things is $38, giving it a price to earnings ratio of around 17. Now, I bought it months ago back when it was 8 times earnings. And back then, when I looked at the company and did my research, I thought it was a no-brainer. And now I'm going to challenge you to make your own investment decision, because this is what you're going to have to do if you hope to be a successful investor within the stock market. Do your own research, think for yourself, be willing to stand out on your own and not follow the crowd, and then ultimately make a decision and stand by it. I gave you all the information on the company, and now it's your decision to make. So, what will you do?